My next guest believes there could be a lot more volatility in store for this market, saying, quote, harmonious relationship between bonds and stocks is likely over. Let's bring in the man behind that quote, Kevin Gordon of Charles Schwab. Welcome back.
Hey, Scott. Good to see you.
The notes, path of least resistance in the current sell-off is likely down. I mean, in fairness, you've been saying that when the market was up, you said the path of least resistance in the current sell-off was likely down.
Well, we got a little bit more last time I was on with you, got a little bit more constructive.
I mean, like
in the June-July period.
It was like you could barely see through the positivity.
Where, there was hope on our part, at least, that given the significant deterioration into May, you had seen a record low in the percentage of stocks that were outperforming the S&P, which to us, that was more of the bearish case, not as much the fact that you had, this concentration up the cap spectrum with just a few stocks, just a handful of names leading the rally. So because of that, in June, you started to see more of a broadening out. That was kind of the case where we saw a lot more optimism going in. Now, of course, the sell-off has been a little bit more broader. You've seen a pretty significant deterioration in breadth lately, but I would still look for signs where you've got a lot more profit taking up the cap spectrum. Maybe you can get a little bit more solid on the breadth side as you move down to the rest of the market.
You take anything at all from NVIDIA and the earnings, which were blowout again, and a somewhat muted reaction today, what that tells you, if anything, about whether, mega cap stocks still have any level of momentum left to propel them higher?
Well, I think what you were talking about with Joe and Steve, with the bond market coming a lot more into focus, it's really the volatility, I think, in yields that's been much more of a driver this time. Because when you actually look back in history, we've done some work on looking at different phases or different stages of volatility within bonds and kind of the two bookends, meaning the most volatile days, the least volatile days, that being the significant driver for stocks. So it's not as much the level of yields that's the problem. It's when you get these spikes.
Right, because from the beginning of earnings season, let's say right before earnings season to now, we're 40 to 50 basis points higher on the 10-year than we were, which some have suggested is the reason why what was a pretty decent earnings season was more muted because market couldn't handle the fact that rates went up as quickly as they did.
Yeah, I think it's part that, but also part of, for the earnings season, you kind of have to go a little bit more below the surface and look at the fact that for a lot of companies, a good chunk of the companies that were earnings beats, put them in that category, it had been up because of pretty aggressive cost cutting. So for revenue growth as a whole, for the S&P 500, if you're using that as the proxy for the market, for the quarter, revenues were basically flat. And in real terms, they were negative. They were down for the third consecutive quarter. So in our mind, it's been more of the case of the market realizing that you had probably gotten as good as it got, you gotten to the stage where it's as good as it gets from an earnings perspective. Now you have to look for the companies that are actually showing organic revenue growth. And for even some of them, whether they're the high flyers and the mega caps that still have a pretty good runway ahead of them, they've had some pretty solid gains year to date. So in our mind, doesn't hurt to take a little bit of profits if that's what people are doing in the market.
Well, I mean, we talked about that with Joe, too, whether the tone and sort of tenor of the market has changed in general, where it's from buy the dip to sell the rip, that, any meaningful move higher, for NVIDIA is a good example of that, right? Stock's up 50%. It's a number, gets a pop off of the initial report, and then it's sold. It was negative, now it's positive, and it's going to fight it out for the next 30 minutes, to see what happens at the end.
Yeah, I think, one of the ways that I would approach volatility and really our message for the entire year, even in a maybe umbrella of caution, would be underneath the surface. Doesn't mean don't stay invested. I think there's a misperception often that if you're cautious or if you're a little bit negative, that means get out of the stock market. That's not how we view things.
Sure.
So leaning into high quality, especially in these times of pullbacks where you're looking for earnings strength, you're looking for profit margin strength. One thing I would now, with the yield story coming into the mix, one thing I would add to that is who has a high interest coverage ratio. Certain sectors like energy actually screen pretty well on that. So I would look at it from a factor viewpoint, not as much as, what sector is going to do well when yields are at whatever level.
What kind of risk do you look at for tomorrow, Jackson
Powell? I think him staying sort of on message in terms of what he's been expressing and kind of consolidating the viewpoint of all the members, saying we're data dependent, nothing's really changed here in terms of what we're looking for inflation and for growth. I think the interesting thing when you're talking about in comparison to last year, very short, very blunt, very much to the point of financial conditions having to tighten more. What I think will be interesting is how he balances the inflation growth dynamic. Because last year, growth was pretty weak heading into the meeting. We didn't have the third quarter GDP report, and then inflation, we still didn't know if it was quite in the rear, if the peak was in the rear view. Now you kind of have the opposite scenario where growth expectations are picking up pretty markedly. I'm not sure if we get to 6%, like some have been suggesting in terms of an outcast, but inflation has definitely been, taking the stairs down. So I think you're in a little bit of a better environment, or at least Powell's in a little bit of a better position to kind of keep us on the path we've been on, which is, let's keep policy restrictive. Let's see where we go from here.
Well, he also has in his pocket that rates have gone up, as we just expressed.
Absolutely.